Title Methods of Note Issue, presented by Dr. R. Rajini, Associate Professor of Economics, Sri GVG Visalakshi College for Women, Udumalpet, Tirupur District, Tamil Nadu, India. Slide 2. Introduction to Note Issue. Note issue refers to the process by which central banks or governments produce and circulate banknotes as legal tender. These banknotes are essential for facilitating transactions and driving economic activity within a nation. The power to issue notes is a cornerstone of monetary sovereignty, directly influencing a nation's financial health and public trust. Slide 3. Evolution of note issue methods. Historically, different countries have implemented various methods for note issue, each with its own strengths and weaknesses. An effective note issue method must balance economy, or cost efficiency, elasticity, or the ability to adjust supply, and public confidence, meaning trust in the currency's value. Slide 4. Key methods of note issue. The key methods of note issue include the fixed fiduciary system, the proportional reserve system, the maximum fiduciary system, and the minimum reserve system. Slide 5. Simple deposit system. In the simple deposit system, 100% of issued currency notes are backed by tangible reserves like gold or silver, a direct representation of the currency principle. This eliminates the risk of overissue and fosters very high public confidence. However, it is highly costly due to extensive metallic reserves, lacks elasticity, and has never been adopted in practice due to impracticality. Slide 6. Fixed fiduciary system. In the fixed fiduciary system, a specified fixed amount of currency is issued against government securities. Any amount exceeding this fixed limit must be fully backed by gold or silver reserves. This guarantees convertibility and controls credit expansion by mandating physical reserves for extra note issuance. Historically, it was pioneered in England by the Bank Charter Act of 1844 and implemented in India from 1862 to 1920. Merits include ensuring convertibility, building confidence, and preventing overissue. Demerits include inelasticity, high costs due to gold requirements, and inconvenience during crises. Slide 7. Proportional reserve system. In the proportional reserve system, a fraction, for example 40%, of the total note issue is backed by gold or silver, while the remaining portion is backed by government securities. The cash reserve ratio links central bank liabilities to member bank deposits, promoting stable prices and exchange rates. In India, it was adopted under the Reserve Bank of India Act of 1933 and replaced in 1956. Advantages include guaranteed convertibility, elasticity, and being economical for developing nations. Disadvantages include the potential for deflation, tying up gold, and offering only unreal convertibility. Slide 8. Maximum fiduciary system. The maximum fiduciary system is considered a modern approach, allowing the central bank to issue notes up to a legally defined maximum limit without full gold backing. Beyond this limit, unlimited issuance is permitted, often against government securities, while maintaining a minimal gold reserve. It is widely adopted globally, including by the United Kingdom and the United States. In India, since 1957, the Reserve Bank maintains a minimum reserve of 200 crore rupees, of which 115 crore must be in gold. Its pros include being highly economical and offering significant elasticity. Its cons include the risk of overissue and the lack of full convertibility. Slide 9. Minimum reserve system. In the minimum reserve system, central banks set a minimum reserve level in cash or government bonds for commercial banks to issue notes. This ensures sufficient backing for legal tender and supports monetary stability. Historically, it was implemented in France until 1928 and in England until 1939. Features include controlled elasticity and prevention of unchecked issuance. Drawbacks include reduced public confidence and the potential for overissue. Slide 10. Conclusion. Towards an ideal system. No single method of note issue is perfect. An ideal system must be economical, elastic, and command public confidence. In the modern globalized financial system, direct convertibility to precious metals is no longer a critical requirement.